My name is Brian Skrobonja, and on this episode of the Common Sense Financial Podcast.
Small businesses in particular could struggle to attract investments under the new tax regime. Investors may become more cautious about putting money into startups or early stage companies that take years to generate returns. Without a steady flow of investment into new business and technologies, economic dynamics could decline, leading to slower growth and reduced productivity gains over time.
Well, hey, everybody, and thank you for listening and joining us today. We hope that this podcast can provide you with some insights to help you grow and get closer to your goals this year. But before we get started, be sure to subscribe to this podcast. That way you'll be notified about new content and you'll be able to listen to Brian tackle a variety of different topics. So you can subscribe on Apple Podcasts, Spotify, Stitcher, SoundCloud, pretty much anywhere that podcasts can be found, and all the links to subscribe as well as past episodes are available on the website at brianskrobonja.com. So thanks again for tuning in, and let's get started.
Opportunities are still there.
The attempt at passing down wealth from generation to generation.
Consider the outcome, not just popular opinion.
And the whole teaching there is about preparedness and being ready.
There's a difference between what's real and what's true. You're listening to the Common Sense Financial Podcast. I'm your host, Brian Skrobonja. Thanks for tuning in, and let's get into today's topic.
In case you haven't heard yet, there's an election coming up, and I don't normally discuss politics on the show, but there is a tax proposal floating that I really wanted to discuss with all of you. Over the last 30 years in business, I've watched 5 presidents: Clinton, Bush, Obama, Trump, Biden, and now we have Trump and Harris. So I've seen my fair share of proposed tax changes. However, a few proposals have generated as much debate and concern as Kamala Harris's plan to tax unrealized capital gains for ultra-high net worth individuals. And while proponents argue this would ensure the wealthiest Americans pay their fair share, the potential implications for the stock market and the broader economy, I think, are significant, and they do warrant careful consideration. The basics of Harris' proposed plan targets individuals with a net worth exceeding $100 million, so that's approximately 10,600 Americans. And yeah, that is a small percentage of the population, but disregarding this and thinking it doesn't apply to you, I think would be a mistake. According to a 2020 study, 93% of stock market wealth is held by the top 10% of households. And if these individuals face a huge tax bill, they will likely find ways to move out of the market and into more tax-favorable investments. And money leaving the market is not good news for anybody. This means your 401k, your company's pension plan, your union's pension plan, all of which are heavily invested in the stock market, could be impacted. And to make matters worse, wealthy investors who have wealth tied up in private investments would face a tax bill on illiquid assets. However, since private company shares aren't publicly traded, they can't easily be sold to raise cash. And as a result, these wealthy individuals might very well likely sell more of their public shares to raise the funds needed to pay the tax on their private shares. Even if the proposed legislation excluded private investments, where do you think the smart money will go? I think it would go into private markets. And where would that money come from? I would think from public markets. And when money flows out of the stock market, that isn't good for you and all the other investors out there. The point is this: if you think this only affects the super rich, please think again. This would impact every household in America with investments, and this proposed idea of taxing unrealized gains shouldn't be ignored. So let's break it down, the key aspects of this proposal, and examine how it could impact all investors, businesses, and their overall financial landscape. The proposed plan from Harris would apply to unrealized gains, which is the increase in value of a stock holding or any other type of investment that hasn't been sold. This marks a dramatic shift from our current system, which only taxes the capital gains at the point of sale. The stated goal is what we're being told is to close what some view as a loophole, allowing the ultra-wealthy to indefinitely defer taxes on appreciated assets. So the theory is by taxing these paper gains annually, the proposal aims to generate additional federal revenue for social programs and possibly towards debt deficit reductions. However, if we dive deeper, it becomes clear that the potential consequences of such a policy shift could be far-reaching and potentially disruptive to the financial markets we've come to know. One of the most immediate concerns surrounding this proposal is its potential to significantly increase market volatility. The stock market is highly sensitive to changes in tax policy, and introducing a new tax on unrealized gains could create a new layer of uncertainty for investors. As wealthy investors adjust their strategies to help them minimize tax liabilities, we could see more frequent trading and portfolio repositioning. This increased activity could lead to greater price fluctuations, particularly in sectors with more volatile stock pricing like technology and growth-oriented industries. The need to regularly reassess and report asset values for tax purposes might incentivize short-term trading over long-term holding strategies. And this shift could undermine market stability and lead to more unpredictable price swings. We might even see a rush to sell appreciated assets before the tax is implemented, which could trigger a broad sell-off and create temporary market disruptions. Another significant concern is how this tax could impact long-term investment strategies. The prospect of being taxed on paper gains before those gains are realized could discourage investors from holding onto appreciated assets for extended periods of time. Long-term investments in growth stocks has traditionally been a core wealth-building strategy, particularly for those expecting their investments to appreciate over time. However, if investors face annual taxation on those gains, regardless of whether they sell, the incentive to hold for the long term diminishes significantly. This could lead to a broader shift in investment behavior, with a move towards shorter-term trading or reallocation into alternative investments that are harder to value and thus more challenging to tax. Private equity, real estate, or offshore accounts might become more attractive options for high net worth individuals seeking to shield their wealth from U.S. tax authorities. The potential for capital flight is a serious concern that I have with Harris's proposal. Wealthy individuals may choose to move their assets to more tax-friendly jurisdictions, reducing liquidity here in the United States stock market and potentially disrupting the broader investment landscape. This exit of capital could have far-reaching consequences. Not only could it reduce the amount of taxable income and unrealized gains that the IRS can capture, but it could also lead to a decrease in domestic investment. This could slow economic growth and job creation, ultimately undermining the very goal the tax aims to achieve. And I believe this is true for most all proposed tax increases. The other issue with Harris's plan is learning the values of every asset. The valuation challenges are a Pandora's box of complexity. While publicly traded stocks have clear market values that can easily be tracked, and other types of assets, such as privately held businesses, real estate, or collectibles, are far more difficult to value accurately. Determining the fair market value of a non-publicly traded asset is a complex and potentially contentious process that could lead to frequent disputes between taxpayers and the IRS. For example, wealthy individuals who own private companies would need to provide accurate valuations of their businesses each year. However, these valuations can fluctuate widely depending on market conditions, earnings reports, and other factors. The administrative burden of enforcing this system could overwhelm the IRS, not to mention the companies and the business owners, which would need to significantly expand its capability to handle the influx of information and audits. Taxpayers, particularly those with complex asset portfolios, would face increased reporting requirements, legal costs, administrative burdens to comply with the new rules. This added complexity opens the door to potential tax avoidance strategies where individuals could underreport the value of their assets or exploit loopholes to minimize their tax liabilities. From a broader economic perspective, there could be unintended casualties to taxing unrealized capital gains that could potentially stifle entrepreneurship and innovation. Many of the wealthiest individuals in the U.S. are founders of technology companies or early-stage investors who have built substantial fortunes by investing in high-growth sectors. These individuals often rely on the appreciation of their stock holdings to fund future ventures, create jobs, and drive innovation. By taxing unrealized gains, the proposal could reduce the incentive for these individuals to invest in new ventures or take on the risks associated with being an entrepreneur. This could slow economic growth by discouraging investment in the very sectors that drive innovation and job creation. It just doesn't make much sense to me to move money from an entrepreneur who can innovate and create jobs to hand it over to the government who spends it on social programs or gives it to other countries, none of which creates growth or jobs. Small businesses in particular could struggle to attract investments under the new tax regime. Investors may become more cautious about putting money into startups or early-stage companies that take years to generate returns. Without a steady flow of investment into new business and technologies, economic dynamics could decline, leading to slower growth and reduced productivity gains over time. I can tell you as a small business owner, the regulations and taxes are a burden. When more time is spent on regulations and more money on taxes, there's less time to create profits and less job opportunity for people in the community. How likely this is from happening is unknown. We all know that politicians say a lot of things that they have no intentions of following through on, but we must consider the ripple effects of what is being floated as a possible tax change. The implementation of a tax on unrealized capital gains is likely to face significant legal and constitutional challenges. The 16th Amendment to the U.S. Constitution grants the federal government the power to tax income, but it does not explicitly allow for the taxation of wealth or unrealized gains. So critics have been arguing that taxing unrealized gains could be seen as a tax on wealth rather than income, and of course that raises concerns about the constitutionality of the proposal. So legal challenges could delay the implementation of the tax and only creates additional uncertainty for investors. The stock market doesn't like uncertainty, and this could further contribute to market volatility. If it gets this far, until the courts can resolve these issues, investors and businesses may be hesitant to make long-term decisions, leading to stagnation and a broader slowdown in economic activity. Another potential consequence of this proposal is a significant market correction. As investors reevaluate their portfolios in light of the new tax regime, there's a case to be made about a broad sell-off, particularly in sectors with high concentration of unrealized gains. This can trigger a downturn in the stock market, especially if wealthy individuals decide to sell off their appreciated assets before the tax is implemented. A sharp market correction could have ripple effects throughout the economy, leading to reduced consumer confidence, slower economic growth, and higher unemployment. And the risk of such a correction underscores the need for careful consideration of the potential consequences of this proposal and how it might affect the broader economic landscape. While the full impact of taxing unrealized gains remains to be seen, it's clear that such a policy shift could have far-reaching implications for investors, businesses, and the economy as a whole, not just for the ultra-wealthy. For high-net-worth individuals who may be affected by this proposal, it's crucial to work closely with financial advisors and tax professionals to develop strategies that minimize potential tax liabilities while still aligning with long-term financial goals. This might involve further diversifying portfolios, exploring alternative investment vehicles, or considering charitable strategies that could help offset potential tax burdens. For the broader investing public, it's important to stay informed about these policy developments and understand how they might impact the overall market landscape. Don't think these tax proposals are for somebody else. This is likely to impact all investors, and so diversification remains a key strategy for managing risk, and investors should be prepared for potentially increased market volatility in the coming years. Ultimately, the impact of taxing unrealized gains will depend on how it is implemented, of course, and how investors respond to the tax environment. As I wrap up, I sense that come November, if Harris wins the White House, we could see investors taking their capital gains before the year end, instead of waiting to see what happens next. There's no crystal ball here, but my thoughts of this would be, if she wins, to consider shifting out of capital gain positions and reallocating into tax-favorable options. You could consider things like a mega Roth to take advantage of catch-up provisions or a specially designed life insurance policy, since these contracts currently do not have limits on how much you can invest and are strategies that are easy to execute. By working with an experienced team of professionals, you can stay informed, and by focusing on your long-term financial goals, you can help yourself prepare for whatever changes may come in the tax and investment landscape. If you want more information, you can visit www.skrobonjafinancialgroup.com. That concludes today's show. I'm Brian Skrobonja. Thank you for listening to the Common Sense Financial Podcast.
Thanks for listening to today's show. If you liked what you heard, be sure to subscribe on YouTube and Spotify so that you can receive notifications when we release new episodes. I'm Brian Skrobonja, and this is the Common Sense Financial Podcast.
Well, thank you for listening to the Forbes Top 10 rated Common Sense Financial Podcast. Before you go, I want to encourage you to jump over to brianskrobonja.com to access the full archive of blogs and podcasts. And if you want to be the first in line to get new content, you can sign up for free on the Brian Skrobonja website as well. If you're not following Brian on all the social channels, we'd love to have you join in on the conversation. Instagram, Facebook, LinkedIn, Twitter, he's there. Lastly, if you've enjoyed listening to today's podcast, or if you have found value in any of our content, help spread the word by sharing our videos, podcasts, and posts wherever you get them. We greatly appreciate it and are glad that you took the time to join us today. Securities offered only by duly registered individuals through Madison Avenue Securities, LLC, member FINRA and SIPC. Advisory services offered only by duly registered individuals through Skrobonja Wealth Management, a registered investment advisor. Tax services offered only through Skrobonja Tax Consulting. Mass does not offer billed banking or tax advice. Skrobonja Financial Group, LLC, Skrobonja Wealth Management, LLC, Skrobonja Insurance Services, LLC, Skrobonja Tax Consulting, and billed banking are not affiliated with Mass. Skrobonja Wealth Management, LLC is a registered investment advisor. Advisory services are only offered to clients and prospective clients where Skrobonja Wealth Management, LLC and its representatives are properly licensed or exempt from licensure. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Billed banking is a DBA of Skrobonja Insurance Services, LLC. Benefits and guarantees are based on the claims-paying ability of the insurance company, not FDIC-insured. Results may vary. Any descriptions involving life insurance policies and its use as an alternative form of financing or risk management techniques are provided for illustration purposes only, will not apply in all situations, may not be fully indicative of any present or future investments, and may be changed at the discretion of the insurance carrier, general partner, and/or manager, and are not intended to reflect guarantees on securities performance. The term billed banking, private banking alternatives, or specially designed life insurance contracts are not meant to insinuate that the issuer is creating a real bank for its clients or communicating that life insurance companies are the same as traditional banking institutions. This material is educational in nature and should not be deemed as a solicitation of any specific product or service. Billed banking is offered by Skrobonja Insurance Services, LLC only and is not offered by Madison Avenue Securities, LLC. Our firm is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by the third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by our firm. References to billed banking, private banking alternatives, or specially designed life insurance contracts are not meant to insinuate that the issuer is creating a real bank for its clients or communicating that life insurance companies are the same as traditional banking institutions. This material is informational in nature and should not be deemed as a solicitation of any specific product or service. Billed banking is not FDIC insured. Billed banking is offered by Skrobonja Insurance Services, LLC only, and is not offered by Madison Avenue Securities, LLC, nor Skrobonja Wealth Management, LLC.
The content of this video is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives. This presentation does not take into account your particular investment objectives, financial situation, or risk tolerance, and may not be suitable for all investors. Information provided is not intended as tax or legal advice and should not be relied on as such. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation.